So, when we think about losing money, our brains usually go straight to the dramatic stuff.
Right, like a total disaster.
Yeah, exactly. We picture this sudden stock market crash just wiping out accounts overnight, or, I don't know, a blown options trade.
Or making a massive bet on one sector that completely collapses.
Right. It's always this loud, highly visible explosion. But what if I told you that one of the biggest threats to your financial well-being isn't a sudden explosion at all?
It's actually a lot quieter than that.
Yeah, it's like this silent, almost imperceptible leak in your financial bucket. Welcome to the Deep Dive. Today we are pulling back the curtain on a specific financial breakdown we found. It's titled, "Here's the Hidden Annual Loss of Failing to Rebalance Your Portfolio."
And we're going to be digging into some really revealing data from Vanguard alongside some pretty hard math from the SEC.
We are, and the core statistic that kicked off this whole investigation is, well, it's genuinely surprising.
Absolutely.
According to Vanguard, doing absolutely nothing to your investment portfolio, like just letting it sit perfectly still, that can cost you 0.5% annually.
Which is just a phenomenal piece of data. I mean,
Okay.
it directly challenges that whole misunderstanding of the set it and forget it philosophy.
Right, because people think that's the golden rule now.
Exactly. The rise of passive investing taught us that excessive trading destroys wealth, which, is true.
Sure.
But people took that to mean that benign neglect is the optimal strategy. They think they can just buy a well-diversified mix of index funds and then walk away for a decade.
Okay, let's unpack this. Because a 0.5% drag doesn't exactly sound like a four-alarm fire at first glance.
No, it really doesn't.
I mean, it sounds like a rounding error. But think about it like a car slowly drifting out of its lane on a long, flat highway.
Oh, that's a good way to look at it.
Right, like you don't notice the gentle veer at first. The steering wheel just pulls a fraction of an inch, and the scenery out the window looks exactly the same.
Yeah, everything feels fine.
But if you take your hands off the wheel and do absolutely nothing to correct that drift, eventually you're driving completely off the road and straight into a ditch.
Right, and that drift is exactly what is happening to the underlying risk profile of your investments when you just ignore them. But I'd actually take the car analogy a step further.
Okay, how so?
Well, it isn't just that the car is drifting. It's like the road itself is shifting underneath the tires.
Wait, shifting. What do you mean?
So we all know the standard target allocations, right?
Yeah.
Let's say you built a classic 60-40 portfolio. 60% equities, 40% fixed income.
The standard setup.
Exactly. And that ratio was calculated based on your specific timeline, your goals, and, your targeted risk level. But markets are dynamic.
Right.
Over a multi-year bull run, your equities might compound at 15% a year, while your bonds are only yielding, say, 4%.
Okay, I see where this is going.
Yeah. So without you making a single trade, that 60-40 easily morphs into a 75-25 or even an 80-20 portfolio.
Wow. Even if you literally didn't touch anything.
Exactly. You haven't executed a single transaction, but your risk profile has completely transformed. You're just no longer driving the vehicle you initially built.
And that transition leads us straight into the mechanics of why this silent leak actually happens. The source material calls this first contributor to the hidden loss excess risks.
Yes, excess risk.
And this is where, behavioral psychology basically collides with math. Because the dangerous drift we're talking about doesn't start when things are going badly.
No, not at all.
The danger actually begins when things in the market are going incredibly well. The drift happens because one of your asset classes is just completely knocking it out of the park and heavily outperforming everything else.
And the irony there is that portfolio drift is born from success, which makes it incredibly difficult to spot as a threat,
Yeah, because you're winning.
Right. Let's say your large cap tech allocation has this stellar run. It jumps up 40% while your defensive assets stay completely flat. On paper, your account balance is higher than it was 12 months ago. You feel wealthier.
Sure, I'd be thrilled.
But beneath the surface of that higher balance, the structural integrity of your portfolio has been compromised.
But wait, let me play devil's advocate here. If my tech allocation is up 40%, literally every instinct I have is screaming at me to let it ride.
Oh, of course. It's human nature.
Right. Like, why on earth would I punish my winners by selling them? If I prune the very branches that are bearing all the fruit just to buy, I don't know, lagging bonds, I feel like I'm capping my own upside.
I hear that all the time.
It's like, think of a cargo ship. If you pile all the heavy treasure on one side of the boat, it looks amazing while the water is calm. But it's fundamentally unstable, right?
What's fascinating here is how well that ship analogy holds up. It perfectly illustrates how deeply ingrained recency bias is in human psychology.
We just assume the calm water lasts forever.
Exactly. We extrapolate current trends indefinitely into the future. But think of an overperforming asset class like a rubber band being stretched to its absolute physical limit.
Okay.
When it's pulled back, it looks incredibly long. The value is high, the chart is going up and to the right, but the further you stretch it, the more immense the underlying tension becomes.
Well, that makes sense. The volatility is just coiled up inside it.
Precisely. Eventually, the market environment changes, and that rubber band wants to snap back to its historical mean.
And rebalancing is what? Easing that tension.
Yes, it's the mechanical process of easing the tension on that rubber band before it violently snaps.
Because when it snaps, it breaks the whole system.
Exactly the mechanism at play. Market corrections are an inevitable feature of the system. They happen.
Right.
If you let that tension build, like if you let your stock allocation drift from 60% way up to 80%, your portfolio is going to suffer an asymmetrical drawdown.
So when the drop happens, it hurts way more than it should have.
Exactly. When a 20% market correction hits, you are suddenly exposed to the full, unmitigated brunt of that equity crash.
Because you don't have the bonds to cushion it anymore.
Right. You lack the mathematical ballast of the 40% bond allocation you originally planned to hold. The hidden loss here is the unnecessary, devastating drawdown your portfolio suffers during a bear market.
Just because you absorbed far more risk than your architecture was designed to handle.
Exactly.
Okay, so excess risk explains the catastrophic damage during a crash. By doing nothing, I secretly opted into massive tail risk.
You did.
But let's say the market doesn't crash. Say it just chops sideways for 5 years with heavy volatility but no massive downturns. The source material outlines a second trap that eats your money even in normal conditions.
Right, the inefficiency trap.
Yeah, lower risk-adjusted returns. Now, I need to ask a really basic question about the fundamental math here.
Sure, go ahead.
Isn't the unbreakable rule of investing that more risk equals more expected return?
People love to say that.
Right. If my portfolio drifted and became more heavily weighted in equities, shouldn't I mathematically be compensated for that extra risk with a higher average yield over time?
Well, that assumption relies on the idea of an efficient portfolio, which is exactly what you lose when you fail to rebalance.
Wait, really? So more risk doesn't always equal more reward?
Not at all. That concept only holds true when you are traveling along the efficient frontier. When the risk you're taking is compensated, systemic risk.
Okay, but fine.
But an unbalanced, drifted portfolio is wildly inefficient. You are taking on uncompensated, idiosyncratic risk.
So it's bad risk.
Exactly. The Vanguard data shows that failing to rebalance significantly degrades your Sharpe ratio. In plain terms, your portfolio's daily volatility spikes, but your overall long-term return does not scale up proportionately to reward you for that nausea.
That is wild. Can we unpack the actual math of that volatility drag for a second?
Definitely.
Because I think people assume if their account goes down 10% one month and up 10% the next month, they're back exactly where they started.
And that right there is the core mathematical illusion that traps so many investors.
The percentages are tricky.
They are. The difference between arithmetic returns and geometric returns is where the hidden loss lives. Let's walk through the exact mechanism.
Okay, let's hear it.
Imagine you have a $100,000 portfolio.
All right.
If it suffers a 50% drawdown because you are over-allocated to risk, your balance drops to $50,000.
Simple enough.
But for you to get back to your original $100,000, you do not need a 50% gain. You need a 100% gain just to break even.
Oh, wow. Yeah.
A 10% loss requires an 11.1% gain to recover. A 20% loss requires a 25% gain. This is called variance drain or volatility drag.
Right, because the negative percentages are calculated off a larger base, and the positive percentages are forced to climb out of a smaller hole.
You nailed it. And if we connect this to the bigger picture, an unbalanced portfolio experiences much wider swings. It drops further in the dips.
Which means it has to climb even harder to recover.
Exactly. Because of the math we just discussed, the deeper the dip, the exponentially harder the portfolio has to work just to get back to zero.
Man, that's rough.
It is. Properly allocated portfolios are designed with non-correlated assets so that when equities zig, bonds or commodities zag.
They balance each other out.
Right. That correlation smooths out the ride, preventing those deep drawdowns and thereby bypassing the worst of the volatility drag. When you let the portfolio drift, you break that non-correlated team dynamic.
So you court massive variance, requiring steeper and steeper climbs just to maintain your baseline.
Exactly.
It's almost like paying for a first-class ticket, but the airline seats you in the back of the plane during extreme turbulence.
That's a great way to put it.
Meanwhile, someone in coach who actually rebalanced is having a perfectly smooth ride. You're paying a premium in stress, absorbing all the violence of the market swings, but the destination hasn't changed.
In fact, mathematically, you might arrive later.
Right. So we know a lack of balance hurts during a crash through excess risk.
Yeah.
And we know it hurts during sideways chop through volatility drag. But here's where it gets really interesting.
Oh, yeah. This is the third trap.
Failing to rebalance also actively punishes you when the market rotates and recovers. The source calls this third silent killer missing the bounce. Let's use a relay race analogy for this one.
I like that. Let's do it.
So if you don't hand the baton to the runner who is rested and ready for the next leg, which is the currently underperforming asset, you literally lose the race.
That is spot on. To understand missing the bounce, we have to look at the historical mechanics of market cycles.
Okay.
Asset classes and sectors do not move in lockstep. They take turns leading the broader market. The high-flying tech sector of one decade often stagnates in the next.
Right. And then something else takes off.
Exactly. Neglected value stocks or emerging markets suddenly catch a bid and soar. It's a constant process of mean reversion and capital rotation.
So if you fail to rebalance, you're missing out.
Completely. Your portfolio remains heavily underweighted in the exact assets that have been underperforming.
Right, because their value shrank and you didn't proactively add any capital to them.
Exactly.
Like, if my small cap value allocation dropped from 15% to 5% of my portfolio over a few bad years, I only have a tiny 5% engine trying to power my wealth when small caps finally have their day in the sun.
And that is the absolute tragedy of a static portfolio. Rebalancing is essentially a mechanical system for capturing the premium of market rotation.
It forces you to act against your instincts.
It does. It forces you to act contrary to your emotions. It feels terrible to sell the asset that's printing money and buy the asset that has been dragging its feet for 3 years.
Right, it feels like a mistake.
But mathematically, you are doing the single most important thing an investor can do. You are systematically selling high and buying low.
You shave the profits off this stretched rubber band and deploy that capital to buy the lagging asset classes at depressed valuations.
Exactly. You're funding the bench for the next season.
I love that. Funding the bench.
When the cycle inevitably turns and capital rotates back into those previously neglected assets, you have a fully restored, robust position ready to catch the upward momentum.
But if you don't rebalance, you just sit there with a tiny, shrunken allocation.
Yeah, you're basically watching the recovery happen from the sidelines. You missed the bounce entirely because you weren't positioned for the rotation.
Okay, so we have the three conceptual traps now. Excess tail risk during a drawdown, daily inefficiency through volatility drag, and missing the bounce during capital rotation.
Those are the big three, yes.
Let's put a receipt on this. How much does this invisible 0.5% drag actually matter in real dollars and cents over a standard investing timeline?
The math here is really eye-opening.
The source text gives us a breakdown that really puts this into perspective. Let's look at a $500,000 portfolio left invested for a typical 20-year horizon.
Okay, let's run the numbers.
If that portfolio is efficiently balanced and earns a historically reasonable 7% compound annual growth rate, over those 20 years, the $500,000 grows to about $1.93 million.
So it almost quadruples.
Right. It's a great outcome.
But look at how the compounding curves diverge when you introduce the drag.
Okay.
If you let the portfolio drift, meaning you absorb the uncompensated risk, suffer the volatility drag, and miss the cyclical bounces, that 0.5% annual loss drops your compound return from 7% to 6.5%.
Which doesn't sound like a lot.
It doesn't. But over those same 20 years, your final balance is just $1.76 million.
Wow. And the math gets exponentially more brutal. The source says if that portfolio drag reaches just 1%, meaning your return is 6% instead of 7%, you end up with just over $1.6 million.
Which is a massive hit.
That is a difference of roughly $330,000. Over $250,000 evaporates simply because of a failure to perform an annual tune-up.
It's wild, isn't it?
It really highlights how a tiny leak, given enough time, sinks the ship. It's not just the 0.5% of the principal that you're losing.
No, it's the compounding.
Right. It's the compound growth that missing money would have generated in years 10, 15, and 20. So what does this all mean?
Well, this raises an important question.
Yeah, like, is rebalancing basically a sneaky Wall Street tactic to generate alpha? Is it some loophole to outsmart the system and beat the market?
And that's exactly the question, and it is a distinction the SEC data makes very clearly.
Okay.
Rebalancing is absolutely not an alpha generation strategy. It is not an effort to beat the market.
It's not.
No, trying to beat the market requires predicting the future, which is speculation. Rebalancing is the ultimate form of risk management.
Risk management, okay.
It's a strictly mechanical, rules-based tool designed to keep your portfolio permanently tethered to your long-term investment objectives. It ensures that the specific amount of risk you agreed to take is the exact amount of risk you are actually taking.
Because without it, the market's random daily variance is essentially dictating your financial future.
Exactly. With it, you remain the architect of your own compounding. And, listeners do not have to take these figures on faith.
Oh, definitely not.
The underlying mathematics are universally available. Anyone can run these exact divergence models on the official SEC investment calculator to see precisely how profoundly a 0.5% or 1% drag alters the trajectory of their specific targets over 20 or 30 years.
It is genuinely staggering when you break down the mechanics of the math. It really all comes back to the incredible value of basic routine maintenance.
Absolutely.
I mean, a couple of hours a year to realign your asset allocation preserves hundreds of thousands of dollars in compound growth.
It's essential financial hygiene. And, as we summarize the architecture of portfolio drift today, it is my responsibility to state the editor's note provided in the Vanguard and SEC materials we've been analyzing.
Yes, very important.
Please remember that this deep dive is strictly for informational purposes and does not constitute financial or investment advice. Investing inherently involves risk, including the possible loss of your principal investment.
Right.
Every financial situation is entirely unique, with different tax implications and timelines, so you should always carefully consider your individual circumstances and consult with a qualified professional financial advisor before making any changes to your asset allocation or your broader portfolio strategy.
Always talk to a professional before making major structural changes to your wealth.
Definitely.
But as we wrap up today, I want to leave you with a broader takeaway to ponder. We spent this time dissecting how rebalancing is the mechanical act of maintaining equilibrium to preserve your wealth.
We have.
We've mapped out exactly how dangerous it is to let your winners run unchecked while starving your underperforming assets of capital.
It's a silent killer.
But think about how that mathematical reality applies outside of your brokerage account. What other areas of your life are silently suffering a hidden annual loss right now?
Oh, that's an interesting way to think about it.
Are you letting your career, like your current winner, run completely unchecked, consuming all your time and energy, all while secretly drifting into excess risk by severely underinvesting in your physical health or your core relationships?
Wow. Yeah, your life has an allocation too.
Exactly. Just like a portfolio, your life has an optimal allocation. If you don't intentionally rebalance, you might wake up one day and realize your risk profile has completely shifted and you are dangerously exposed to a crash in the areas you neglected.
That is a very powerful thought.
It is worth thinking about where you need to take some profits and purposefully reinvest in the vital areas of your life that have been drifting sideways. Thank you so much for joining us on another custom analysis.
Thanks for listening.
We hope this uncovered some mechanical blind spots and gave you the tools to keep your compounding curve on track. Keep questioning the mechanics behind the numbers, keep exploring, and we will see you next time.